All right, welcome in everybody. What's wrong with my camera? It's too high. I've been working on getting all my stuff ready. All right, so man, I was having epiphanies all over the weekend. I need to get back with y'all so y'all can calm me down because I was really in an exciting place over the weekend. Because I was almost at the point, I was talking to Beth, I'm almost at the point that I'm thinking, hey man, there may be a way that we'll even automate this AIM stuff. It's such a brilliant little system. We may automate this thing, just put it on, you know, put it on auto drive, let the thing work. It was cool over the weekend as I was toying, as I do. Now, keep in mind, I love toying with things, making it mine, right? So, we've got the Licello book that you and I have been devouring and making, a spreadsheet based on that will hopefully outperform the baseline of the S&P 500. And it was cool because over the weekend, I just kept playing and toying and doing some things. And I want to show that to you today, just so that you'll get an idea of where I'm coming from and what I was doing. The first thing that I did is I said, let's look at how AIM is doing in relation to the S&P 500, right? So we're only in this campaign for a couple of weeks, if that, maybe a week and a half. So let's just see how it's doing in comparison to the baseline of the S&P 500. So let's draw that up. So here we go. So I said, what if you took a portfolio and in a $35,000 portfolio, what if on the same day that we started the AIM system, right? What if we had put the entire, no cash at all in the account, but we had just bought 88 shares of SPY? So that would have given us, let's see what that looks like over here. If we had bought that in a $35,000 account, then that would have, filled us up. We could not have bought another share. So if we did that, what would that look like as far as, the returns of a 100% SPY account? So then I went and did the SPY net lick for each day based on that. And so the results were really good, right? So if you took SPY and you went 100% in a $35,000 account, that account would be up 4.21%, which is really good, right? I mean, you're mirroring the market, and the market has, as we know, has been nothing but up. Okay, so now let's look at our AIM dashboard. What if you had, as we did in this AIM dashboard, what if you said, well, how about this? Let's go into 10 different ultra strong, ultra pro share stuff that move, in 3 times the market, 2 times the market, 2 times silver, 2 times oil, 2 times all this different stuff, right? 2 times the Dow, 3 times the Dow, 3 times, the Qs. What if you put, so this is our current allocation where we're in 75% stock, right, in various underlines. And then the cash, we're keeping 25% of the account in cash. How does that compare to what the S&P 500 has done? Well, I don't think it'd be a surprise. You would think that if you're putting your stuff in ultra things, right, that are ultra, like UPRO, 3 times what the S&P 500 is, you would expect this one to maybe be up a little. But then you've got silver and you've got, all different kind of stuff, oil, you got all different other kind of products. And we're parking 25% in cash. Is it possible that this AIM portfolio with all of this could outperform the S&P 500? So the S&P 500 is up 4.12%, right? So let's look at the AIM net lick. And I went and changed this from what we did on, I changed it to what it was at the market close, right? So at the market close, the actual return of the AIM portfolio, even though we had 25% in cash or cash equivalents, was up 4.5%. That's pretty strong, right? However, we do need to keep in mind it's been nothing but a bull market, right? So what's going to happen to our AIM portfolio once the market corrects some and goes down? So I just had a lot of thoughts over the weekend, and I will share those with you because we always share here. But over the course of what I was thinking over the weekend, I was almost to the point that I go, oh my, I think we're on the verge of something humongous. And we may not be, y'all. Keep in mind, I am the worst trader on the planet. There's nobody worse than me. I make all the mistakes. I have lost Teslas galore. I'll probably never own one because all the money that I lost I call it Teslas. Every time I lose a humongous sum of money. And keep in mind, I'm also at that point where I told you, I don't like chasing new and shiny things, right? When you've got some things that are working for you, you need to stay with those. But this is making so much sense about how this AIM program works that I was like, this one may be worth experimenting, right? It may be worth a point to where we, look at this and go, hey, is this something that can consistently outperform the market? And I don't know if it does, because I'm the guy who, when a friend comes to me and says, hey, Bobby, let's start raising goats. And this is 20, 30 years ago, right? Let's start raising goats. And I'm like, goats? What do you do with goats, man? He's like, the Cubans love them, Bob. They love to eat the goat. And I'm like, get out of here. So we had it planned where we're going to raise goats and sell it to the Cubans. Now, keep in mind, I was not forward thinking enough to think, hey, wait a minute, how do you get the goats to the Cubans, right? I mean, you can't just ship my goat to Cuba to get it down. So we didn't think through a lot of things. So we lost a lot of money on the goats. Then, someone come to me and approached me and said, hey, Bob, I've got a real estate advertising magazine that I own. Boy, you'd be great for this. And then I bought the magazine, right? And not thinking, hey, dude, nobody's looking at card paper magazine advertising, real estate books anymore. They're, everything's on their phone and on the web. So I have an inability to see the future in so many things. But I keep in mind that we know that Edison, failed in his design of the light bulb. So every now and then, the blind squirrel will find a nut if you just keep on long enough, right? So let's just see what I want to take you through my thought process, okay? So what I also did, and you're not going to see it here because I deleted it all, but I basically went in and said, okay, how would each one of these 10, and I didn't use the Ford and Cisco and the Walgreens, right? I didn't use those, but on these ultra products, how would these have performed if we did the same thing as SPY? In other words, we filled up the $35,000 account with TQQQ. How would that have looked? If we filled it up with the Dow, UDOW, how would that have looked? So I did all 10 of these ultra products, and the results were really promising. So if you had put all 35,000 into your account in UMDD, how would that have performed? Now I just kind of saw the leaders and the laggers in that outlay where I did that. So that brought me to this, and don't let this scare anybody, but let's just talk about what we did. So then I took and with the 10, would you like to save? Sure. Just don't open that up. So we went out and got our TradingView account, and I looked at, hey, how about over the last month, and then I looked at the last 5 days, how would each of these 10 ultra movers, UDOW, UPRO, TQQQ, how would that look in comparison to the Dow performance, right? I mean, to the S&P 500 performance. So here's how they look. This is how each one of those look. Each one of those has their own percentage returns, right? So you can clearly see the TQQQ was the way to go, man. If you could have had your entire AIM portfolio in TQQQ and then put, 20% in the cash, that would have been the best result over the last 5 days. So here, you'll see everything starts at 0, right? This is everything starting 5 days ago. And then it shows you how they all branch out. And here's what the S&P 500 did. Here's the 0 line, right? There's a 0 line here somewhere. Here, I guess. And it shows you how each one had compared. So, the UCO was our worst performing ultra pro shares underlying, right? So it was down 4.3%. And so on and so on. Now, keep in mind, I started looking at this, I go, that says negative 2.8, but that's not negative 2.8, that's 2.8. So we got to be able to look at those and make sure that we got it. Let me make sure I got that on a 5-day. 5-day, because when I moved that, things were changing and doing, okay, here we go. So this is the 5-day, right? Why did everything change? Just make sure we're 5-day, 5 minute. I also looked at this on a 1 month, right? Just to see what it would look like at a 1 month. Because I don't know what our adjustment method needs to be, right? So this is going back a month and showing you the performance of all 10 of these underlines. So kind of a cool concept, right? So then it occurred to me, God, we got a full house today. Welcome in, everybody. Hey, Ken. Hey, Tom. Hey, Rick, Dimitri, Dwayne, Matt, and Jim, and Dez. Wow, Dez. So we got Dez in the ring. Interesting. All right, so we look at this and we say, what about if we were to allocate more resources to the hot hand, so to speak? What if we were to allocate more resources to the hot hand? So in other words, you go, okay, TQQQ is our highest performer, UPRO is kicking it, UDOW is kicking it, and those are the only 3 that are above the performance of SPY, right? How's it look on a 5-day? I think there were more than that on a 5-day. So let's go to the 5-day. Yeah, so the Qs, UPRO, UCO, UDOW. So you see the different returns and how they're doing in comparison to that. So when I was working on this last night, I went back to the spreadsheet and came up with this just to see everything. So apparently what happens is that the AIM system seems to work better with those things that have high betas, right? So what is beta? Let's talk about what is beta. Well, the S&P 500 has a beta of 1. So all I did is use this little formula here, stocks. So you can put in a symbol, and you can pull in all different kinds of information, right, for the beta. So I pulled this in using this little tool here, and I can show you guys how to do this or share it with you. But it was interesting to see what the betas of each one of these 10 underlines were. So we can see the ultra is the UPRO is supposed to be 3 times that of the movement of SPY, and there it is. It's 3.19. So in comparison, the TQQQ is 3.33. So basically, I just ranked these as far as their betas, okay? Because in this system, you want movement up and down, right? We want things to go up. We want things to go down. So I thought, wouldn't it be interesting now if we now list the 5-day percentage return of each one of these items, right? To see what it was on that board. Now, it may have changed from when I did this last night to the price that we have today. But basically, I went in and took the 5-day return of each one of these items and placed that in. And then I multiply them, right? So I take the beta times the 5-day return and multiply that by 100 to kind of give us the product, right? The product here. So if you did that on the SPIs, you came out with 1.8. If you did that here, right, then it gives you all the numbers that we have here. So then I basically said, okay, look, which one of these outperformed? Did it outperform the number here? Did it outperform the S&P 500? So based on the numbers that I came in through last night, we had a number of those that said, yeah, okay, these outperform. These three did not outperform the S&P 500. So these were less. Those were the numbers that were less. So then, and this is kind of where I'm at now, and I'm just taking you through a progression of what we're going through, because this is kind of a cool thing, right? So then I said, okay, if these are the ones with the hot hand, these are the ones that are, you know, they're outperforming the S&P 500. What about if we did an allocation to those particular underlines that was greater, and then we punish, so to speak, the underperformers, right? So we punish the three that are underperforming. Now, you'll see here, I don't have anything allocated to them. And while I was in my bed last night, you know, as often does, I'll think about these things and it comes to me. I was like, well, it's probably not fair, Bob, for you to totally disregard these and totally sell out, right? Don't sell out just because it had a bad week. I mean, because as we've said before, these things kind of revert, right? I mean, underperformers, you know, have a tendency to go back up, and then these as well may have a tendency to go back down. But for the next week, will these three continue to outperform the S&P 500? And on a short-term basis, I think that's a pretty good overall bet, right? Even though you and I are contrarians, you know, and we're always looking to sell what's up and to buy what's down, maybe in the short term, these that are outperforming will continue at least for 5 days, which would be through Friday, to outperform the general S&P 500. So it gives an interesting way to say, okay, we're betting on movement, right? Because of the beta. The higher beta, the better that an underlying is rewarded, an allocation of funds. Then we say, what's the hot hand, right? How have they performed over the last 5 days? Then we kind of combine those two into giving us, you know, a number that we can actually do something with. Then we compare it to the performance of the S&P 500 and say, yeah, you're an outperformer. You've done well this week. We're going to bet on you for the next week that you're going to continue going up. Then, based on how well you outperformed, we're going to allocate more funds toward you, while we're also going to punish the underperformers by taking funds away from them. Now, since I want to keep positions in all 10 and not just liquidate, so we don't want to just go in and sell everything in ULE and UCO and URTY. We don't want to just go in and sell all of those things. But at the same moment, we'll probably just want to allocate a smaller percentage of the portfolio to them, and then start upping the percentages that we do here. So my initial thought lying in bed last night with crickets in my head was to go, okay, we'll allocate these three a minimum of 5% of the portfolio. So what's that? In a $35,000 account, 5 times 30,000 is what, 1,500. We'll allocate a little over 1,500 to these three. And then we'll take these numbers to figure out an allocation of greater percentages to these, so that perhaps we don't even need portfolio control anymore. You know, maybe we don't need Lacello's portfolio control. We just go with the hot hand method. And, you know, now if during the week, you know, something drops precipitously, then the Lacello, you know, algorithm kicks in and tells us to sell. And if things go up really big, it tells us to buy. So, it's an interesting thing. And I'm thinking that what is outperforming in the short run, the TQQQ may continue on a weekly basis. Now, how often do we want to change this allocation? How often do we want to do this? Well, that's what we don't know, right? That's what we don't know. I did find a back test of the Licello algorithm, and it did have, like, I think a weekly and a monthly and a daily change, and the daily did outperform, but it was slight, right? And you guys, all of you guys, have jobs that you're doing outside of trading. How often do you want to look at this? And so that's the beauty, right? Is that the results were not significantly different. You did make a little bit more money if you did it more often, but maybe your time horizon is once a month, once a quarter. Jolly Wally, he's got his portfolio going on this now, and how often does he want to look and make these changes? The cool thing is you and I can design the spreadsheet to tell us what to do, right? So if you've got a few minutes every day, and you can go in and make the changes. But what I was thinking is let's look at doing it maybe once a week, right? We look at the return on Friday, and then that tells us the allocation for Monday. And I'll fix this and work it in and just see how it goes. I'm thinking, now, first of all, does everyone understand the logic? And I love, your guys, opinions on things and going, Bobby, this is the biggest crock of garbage I've ever heard in my life. This is stupid. Or do you kind of see where maybe this is a cool little thing, right? So we still have product diversification, right? But we're just allocating more resources, buying more into those that are outperforming the market. As I was sitting there lying in bed and working on this all over the weekend, I think it has great potential. Now, could we back test this? Potentially, right? We could potentially back test it. Or we could do an allocation of funds, I think, as we're doing now, to see how this does in the future. But I think the concept is very, very strong. I think it's very, very strong. Any questions so far?
No, that looks good to me, Bobby. I mean, you put a lot of thought in that for sure, tweaking this and making it. Hey, listen, I just wish that my brain would work in the daytime like yours seems to work at night.
Yeah, when I'm at night, man, I can't sleep, right? So I'm up at 4 in the morning. This is what's going through my head. I wish it wouldn't. It's a curse more than anything, but I do think about these things because keep in mind, what am I trying to do? First of all, I got to think about what I'm trying to do. Now, since I've been logging my food, eating my little granola bars and doing everything, my health is much better. So I don't have that. I think I'm doing what's necessary to keep me going, right? And so that Beth doesn't have to worry about growing an account. But as I sat here last night, I said, you know what? We can pretty much, if we're on this right and correct path, we can pretty much automate this. That was my thinking, is that we can pretty much automate this at some point, the logic behind it. And I don't know exactly how to do it, but we could probably have this thing on, autopilot some way, somehow. If nothing else, then saying, hey, buy 5 shares of this today, sell 3 shares of that. I think we can certainly do that. And that's why I was thinking last night, I'm like, dude, I really don't want to grow our group anymore, right? I'm like, I like the group that we have. We got Dez that steps in today. That's fine, but I'm like, let's try not to grow it anymore. And I think what we've got is something that if we'll all put our heads together, it's kind of a cool little way that we could do something that does both. The trend is your friend, right? The short-term trend, if this is up, okay, we got that. But it also has those contrarian pieces as well. So that if something were to go up significantly, then we may get a sell signal. The algorithm may give us a sell signal as well. So I think this is really something pretty special. Now, you know, in my condition specifically, that Beth could easily come into. I mean, this is almost, she knows how to sell options, right? She knows I built the dashboard and the other spreadsheet to tell us how to do that. But I'm thinking that this one is going to be a little easier, where she goes in here, and we've seen the trigger before, right? Where it says buy 5 shares, right? You've seen this work. We've seen these triggers say, do different things. And so it's working in the background, and you and I are doing nothing. She could look at this once a day and make her decisions. So it's just really, really cool, right? So then you'd say, well, if cash got down, got up too much, say we had 40% in cash, then we can design this thing to say, hey, dude, that's too much. Get your cash back down to, 20% or 25% or whatever you're comfortable holding. So, some of you may say, hey, Bob, I don't want to do the 80-20. Right? I don't want to do the 80. I want to do something much more conservative. You could do the 50-50, right? So at some point we can build it in where you just tell this thing, hey, I want to do 80% to the underlines, I want to do 20% to cash, and then it automatically does it. Now, in the same way that we're evaluating our cash equivalents, right? We've got J and K holding cash, we've got O holding cash, because we're trying to let everything work, right? We want everything to be able to work. We can use this same logic to evaluate 4 or 5 cash equivalents as well, right? So then you're saying, okay, so go with the hot hand as well on the cash equivalents, right? You look at this as a comparison chart and go, yeah, let's put 4 or 5 cash equivalents in there, seeing who's outperforming, and then just allocate more resources toward the outperformer. Those that are underperforming, then we'll take a little bit of resources out, but maybe you have positions in those, in all 5, right, with a greater percentage of that one that's outperforming.
So, Bobby, on this, evidently there would be more daily adjustment than the normal aim that you have. I mean, we would be taking action more, which is not a problem necessarily. That's just the way it seems to me.
What I'm thinking though, Rick, I'm thinking that we just do it weekly, right?
Yep.
I mean, I think that's a happy spot right now. Now, if you want to put yours on monthly, do it monthly. I think that's fine. So what I'm trying to do is to come up with something so all of us have a nice little strategy to where, you got a life outside of this, right? You can put it on. You want to check it once a month, do it once a month. You want to do it, once a week, do it once a week. You want to do it once a day, do it once a day. So hopefully by implementing something like this, that we could have something to where if you're working and you're on your lunch hour, that you could come in and say, hey, am I getting any signals? And on your phone while you're at work or in the bathroom or out in the cutlass smoking, the Lucky Strike, that you could make your daily or weekly adjustment. So if you're doing it weekly, you could do it at right before the market closes on Friday, or you could, make your changes on, Monday morning right after the market opens. So I think it's going to give us all just a little bit of something to where you go, man, this is autopilot. If you're at SeaWorld with the family, or looks like we're going to Myrtle Beach now. By the way, this just ticks me off. So we have our condo booked at Myrtle Beach, right? Beth found a great deal, she thinks, and we've searched so many different places. And then all of a sudden, they come out, and after we booked it, said, oh, okay, now you have to buy a linen package. Buy a linen package, so you have to rent the sheets for the freaking bed. Or you can bring your own sheets. Okay, I got 7 people in my family. I got 5 kids, and my mama's going too. That's 8 of us. We don't want to pack up 8 sets of sheets or whatever to go up there. And oh my gosh. So, or you could rent their linens for $140. Are you kidding? I mean, who gets, who books at the Motel 6 and goes, okay, the Motel 6 is $39 tonight, but we're going to charge you $20 for your sheets. Get out of here. Don't do that to me. So we canceled that one, and we're looking at something else now.
If I was going to the Motel 6, I would bring my own sheets no matter what.
You're probably right. Hey, Tom, you've never stayed in the Sequoia Inn in Somerville, Georgia. Let me tell you something. That was, I hate that I actually took the sheet off that bed to look under, to look off the mattress. Oh, me. No, needless to say, I slept fully clothed in that hotel back during the day. It was one of those that had mirrors on the top of the Sequoia Inn. I'll never forget it. Mirrors on the top of the, yeah, that was something. Now that's the kind of places that we stayed when we were children. Right? It was like, you think about how easy it is today to book a room or somewhere. I mean, we would head to Panama City Beach, and you didn't have a clue where you were going to stay in. And so if everything was booked up, you had to stay wherever you could. But those were fun times as well. I remember just searching for somewhere to stay.
Yeah, I just booked a house in Naples for a week, Florida, and I think there's a $300 COVID cleaning fee that
Oh
they
my
tacked on.
gosh! Yeah, look at that. A COVID cleaning fee of $300.
Like, you weren't going to clean it before? I mean,
Right. And don't tell me you're doing that much more, right? But
Right.
it gives them an excuse to say, hey, look, we'll get a premium on that. I don't fault anything. And I'll tell you, apparently the prices of, vacation destinations is out of control because everybody's excited to get back out there. And it's just supply and demand. It's just supply and demand. I understand that. But Tom, you have no idea how great it would be for you to take me with you. I mean, what a great conversationalist I am. I mean, we'll listen to Elton John. We'll jump into Cutlass and head on down. So if I could get Beth to just let me go, that's the thing. She won't even let me go fishing.
oh, sounds good. I'll give you the address.
Okay. Hey guys, what do y'all think about this? Am I off my rocker? Am I anyone seeing the positive of this? Or maybe we should just leave it alone, let it do what it's supposed to do. But I'm thinking you can really, if we're outperforming the SP 500 now, I just think we can really do maybe something even better by allocating more resources to the hot hand.
No, it sounds like to me you may be onto something here, Bobby. I really like the idea.
I think it's worth toying with, right? I think it's certainly worth toying with.
I would like to see what it does in a pullback, in a multi-week pullback. I mean, I think yours, the new way, you would be more. Let me back up. Never mind, a bad thought. But I would like to see it in a pullback. I don't know if there's any way to back test this or not. I'm not sure.
Yeah, and I'm not the world's best back tester at all, and especially if you're using U Delta Pro, I can't think of a single way that I could use that to back test it. But I mean, it's it's just something that's really an interesting concept. Yeah, how would it do? I mean, if you're putting more money to the one that's outperforming, okay, you're putting more money to the TQQ, right? So yeah, what if that is the booger that has the biggest, pullback all of a sudden, and you've got.
I would look the other way. I would look at the stuff that's underperforming and maybe allocate more at the underperforming pieces.
That's my take too.
Yeah, like the dogs that I just put in chat, but like the dogs of the Dow strategy, once a year, you buy the 10 lowest in the Dow, or the highest yielding, whatever. But maybe instead of putting the money on the stuff that's been moving the most, it might be, because I don't think any of these are bad strategies. Just, hey, if something's underperforming, that might be where to allocate.
Right. Yeah, and that's certainly the contrarian in us, right? That what is underperforming is going to have some reversion to the mean. Because if you did have a big reversion, these coming back, then yeah, you certainly could get hurt by allocating more to it. The thing is, let's look at it on a 3-month. So, I would think if that's the case, then I would look at it on probably a longer term.
That's where I'm at there, Bobby, is I I agree with Tom on almost all of this, but your idea has merit. It's like the contrarian of the contrarian. I would do it on a quarterly basis
Yeah, on
or
a
every
3 monthly
month.
base, 3 months,
Yeah,
right?
2 or 3 months. Yeah. The idea is there's just noise, and there's noise of a weekly level, noise of a daily level, noise of an hourly level. It just bounces back and forth, and it seems a 5 day period is you might end up whipsawing your account into oblivion, and because the fundamental concept is contrarian to begin with. But I like the concept of reassessing. The same time you reallocate cash, maybe you should reallocate the portfolio. Do everything like on a quarterly basis. Um, I do like. There's elements of that concept that I like, and that's my 2 cents.
Yeah, I think you're right. It's not necessarily, we don't have to necessarily go with the hot hand, on a short-term basis. Maybe it is the 3 months that
Well,
we're,
what I was thinking, I've been thinking about something like this for since the beginning, uh, and I'm not much on technical analysis. I use WD-GAN and some other weird stuff, but the the big boys use the 200-day moving average above and below, and they do use the 50-day moving average. I'd almost think of a stupid, simple trend system to help guide where where you get where you know shift your funds. Let that be the guide instead of a straight comparison to the S&P. Right now the S&P's biased up. It's got that Brownian motion that keeps going up no matter what, and we're in a bull market. So when is that ever going to end? I don't think it's going to. Yeah.
so that's interesting, Ken, you bring up the 200-day moving average, right? So that red line there, I had it hid. I just put in there as the 200-day moving average. And yeah, certainly, right? If, for example, if SPY gets below its 200-day moving average, then everything that is, lockstep in line with, the market, for example, the UDAO, the UPRO, and the TQQ, right? That would affect all three of those.
Mhm.
Then you would say, hey, the allocation on those may be lower, right? If
Yeah.
if the S&P starts going down here. So there's a lot of different ways that we can skin this cat. And I like what you guys said. Hey, Bobby, we just do the opposite of what you were talking about. Instead of, going to the hot hand, we go to the one that's underperforming, of thinking that there will be some type of reversion, to the mean. I like all these concepts. I think what, if we'll just think about this and, maybe there's a way we can change the trigger, based on something as simple like the 200-day moving average. Yeah, dogs of the Dow is to allocate more to the underperforming sector. Yeah, yeah. And I think Lucello did with the dogs of the Dow, didn't he? He did that.
He did have a test portfolio, and it was pretty good.
Yeah, it was pretty good.
Mhm.
So, so maybe that's what we need to do. Nonetheless, I think it's given us a nice little recipe for coming up with something here to do an allocation based on performance or where we think things are going to go. So it's really really interesting. I did something over the weekend. I'm contemplating doing is transferring my account over to Tasty Works. I just, I don't know, I've gone back and forth with Tom Shoshnoff, as Beth says, in emails, just making sure that they're going to have some of the things that I think we need. And, I know they promise a lot, but I don't know, it just seems pretty sweet deal. So I'm contemplating that. But in the meantime, I will try to continue working on our dashboard so that, you can say maybe, hey, I'm bullish. So if you're bullish, then your assumptions will do one thing. If you're bearish, your assumptions on allocation will do another thing. Or maybe we just build it into something simple like the 50-day moving average or the 200 moving average. So, the good thing is Beth, last week she's saying, hey, you're spending so much time up in your, Beth, what'd you call my office? She's up in here. Anyway, she called it my something, my little office. She's like, you need to come down more. And, with something like this, maybe we could, right? We just have this thing, come in once a day, look at it. Does it say make an adjustment? Or come in once a week or once a month, whatever your time frame is, so that you can do it. And she's like, oh man, don't spend a whole hour on our vacation, doing all this stuff. And let's make sure we're out with the kids, at the beach. So that's what I'm trying to do. I'm really trying to make it easier on me and her so that we have something that automatically works, something that just, this is so simple. But man, I really think that what we're putting together here is really, really special. Matt, you're quiet today. What's going on with you?
I'm listening to a safety course in the background and I'm drawing houses. So I'm just here.
Boy, that sounds fascinating, man. It really does. A safety course. That's good. But we do what we have to do, right? So let's keep playing with this. Again, I like Tom and Ken's idea. Hey, maybe, we allocate it down here to the underperformers. Or maybe we come up with our formula based on, what are the percentages on a 3 month, on 1 month, and a 1 day to come up with some product to compare them. I mean, there's a lot of different things that you and I can do to.
Here's an idea about this that you would use in a lab. Is
Okay.
you take the outliers.
Yep.
You take the biggest gainer and the biggest loser, and cast those out or reinvest in them. In this case, instead of getting rid of them, you buy more into each, the biggest and the strongest and the weakest, and that kind of fills both. It kind of gets both ends. That's just an idea, because that's what you do in the lab. You take the extreme and you drop them as anomalous, and then you do your statistics based on what's left.
That's kind of interesting. So maybe, and like, as you said, maybe instead of dropping them, right, you take the two extremes, you take this one and you take this one, and allocate more toward each, right?
Yeah, and that might be this is just all thinking out loud.
Oh yeah.
As I for one, I have this in the back of my head. I think that this is the allocation, reallocating based on price. I think that's built into the system. It's just when something goes down, you buy more of it. When something goes up, you sell it, and that way the percentage shifts in the portfolio, and so it might be inherently, this shifting might be inherently there. But that being said, I'd like to have some more oversight in it, more decision making, to put more in on if something's on a hot streak, you want to definitely get on board.
Sure.
Yeah.
So and I think that's what I'll focus on with our dashboard on this, is to come up with some input things like, if this, then that. So, if we, and that way we could easily do it, right? Instead of going in and changing all these little formulas that we got on, we can have the formulas according to our assumptions. So if you're assuming that the Qs are going to be, outperforming the next week, then you can certainly allocate more to it. So yeah, we could, put a scale in there of how you'd like to scale them, for the coming week or coming month, all kinds of different stuff that we can do with this. And then we just sit back and let it tell us what to do. And I think what I really like about this, right, is it 100% takes out fear and greed in our decision-making process. So we've got fear, we've got greed, and as we've also identified, you have trade envy. But I think with this, fear and greed are managed really, really, really good. And what I like keeping as a part of the system is this, and I know it drives some people crazy, but how are we doing compared to a 100% SPY portfolio, right? That's the market. That's what, Warren Buffett says, hey, you know, all these hedge fund managers, you're never going to outperform the S&P 500. And so everybody tries to do that. So we try to come up with something that says, oh, yes, we will, if only a little bit. And we're safer too, because we've got 25% of our account in cash, whereas the SPY account has 100% in SPY. So that's what we're trying to do, right? And so if you'll keep monitoring this, which I will, I'm going to keep monitoring. Well, how's the SPY portfolio doing in comparison to, you know, the AIM portfolio? And that way we'll know, oh, wow, by making that change, you know, we're on this path of underperforming, or we're on a path of overperforming, and we can kind of, you know, we're testing this thing in real life with real dollars, instead of back testing or just thinking in a live account. But I like what we've talked about here today. Anyone else got any opinions or anything before I take the rest of the day and start working on this little puppy some more and see what we can come up with for tomorrow? Anything at all? All right. Well, if you have a thought, shoot it to me. And if not, I will see y'all tomorrow.